welcome back. We got ourselves another weekly market update here. Hope everyone is doing well. As always, if you have any questions, comments, concerns, just feel free to reach out. We're happy to help out any way we can. So for the weekly market report for the week of the 28th, here we go. So here's the good thing, or really just good news right now, which is the first quarter earnings season is largely in the books, and to put it frankly, it was excellent. In fact, the S&P 500 earnings per share, or EPS, would have been double digits in the quarter if it wasn't for one company, Bristol Myers Squibb, BMY, who was absorbed in an acquisition. Even with them not performing well, from the drug maker just really kind of falling apart at the seams here, there was nearly a 7% increase in earnings, which is the biggest since the first quarter of 2022. And it's really impressive. Big tech strength was again the primary driver as estimates impressively rose. So tech is leading the way here, but 500 companies reported, almost all of them knocked it out of the park here. So it turns out so just to put it into perspective, so overall the S&P 500 growth tracked at about 7%. If it wasn't for BMY, the number would have been about 9.5%. So if you remove biotech and pharmaceuticals and the S&P 500 EPS, this would be almost 10.5%. So there's still about 20 companies left to report, but this is phenomenal. We're going to look at all the results in about a week or so, but that doesn't change the fact that earnings are currently growing in a solid mid to high single-digit pace, which is a realistic opportunity for even stronger growth in the coming quarters. So I know we get caught up in the narratives of everything, but the bottom line is that after this first quarter reporting on earnings, a lot of companies knocked it out of the park. Better than expected profit margins played a role in the strong first quarter numbers. The S&P 500 net margin is tracking to 12.3% for the first quarter, which is up from 12.2% in the seasonally stronger fourth quarter. That doesn't sound great, but given consumers are starting to push back against higher prices, which you saw from Starbucks, McDonald's, Targets, and others, the first quarter is seasonally weak, or should have been weak, but the results are saying otherwise. If companies can continue to control costs, then improving margins for the rest of the year seem doable. Economic growth is supportive here. Wage pressures seem to be stabilizing as the job market loosens up a bit. Consumer prices are increasing at a faster pace than the wholesale prices. Using the latest readings from the Consumer Price Index, CPI, and the Producer Price Index, PPI, which support the margins. And margins in healthcare and energy are depressed and poised to reverse. One risk is further consumer pushback on the high prices as savings dwindle, so it's definitely something to keep an eye on. Higher commodity and borrowing costs present potential headwinds, but the bottom line is that companies have adjusted to 5% interest rates and are making money, which is, at the end of the day, as an investor, what you love to see. As per usual, big tech, again, is driving all the growth here. So the biggest earning growers, namely Google, Amazon, Meta, Microsoft, and NVIDIA, which we touched on last week, were really the biggest drivers. So the biggest drivers, right? So those five companies drove about 7.8 points of the S&P 500 earnings per share growth in the quarter, which means the rest of the market in aggregate, so just call it the S&P 495 or 493, if you want to just include the Magnificent Seven, experienced a 1% year-over-year drop in earnings. So growth among the mega caps is really impressive. So earnings from NVIDIA surging about 468%, Amazon 221%, Meta 111%, Google not too shabby at 56%. So it's, once again, it's the Magnificent Seven that are really carrying a lot of the workload this year. That being said, the rest of the companies seem to be catching up to the pack here. So the bottom line, right? And I think this is the biggest conclusion to take away, which is first quarter earnings season was excellent. Corporate America delivered when it needed to. When stock valuations had gotten a bit more elevated, which was something I was worried about to start the quarter, the earnings are catching up and meeting that point. Earnings growth rates were stronger than anticipated, and upbeat guidance caused analysis to increase estimates. There's some outliers here and there, but overall, everyone's looking positive as we go into 2024. If the companies can deliver near consensus earning estimates in 2024, buoyed by the big tech companies that I just mentioned, and inflation continues to resume its downward trajectory, bam, we get a soft landing. And we believe stocks stand a good chance of adding year-to-date gains through the year end and hold price-to-earnings ratio above 20. If a slower economy weighs on earnings in the second half and inflation remains frustratingly sticky, which is very much in play, then we consider the fair value for the S&P 500 at year end to be closer to our the LPL's original prediction of 48.50 to 49.50. So it's we'll see. But the good news is that companies reported and we're making money at the end of the day. So we're going to see how this plays out in real time. That's our weekly market update, guys, and we'll talk soon. Everyone have a good day.